Hello, everyone. This is Sebastian McMahon from IA Financial Group. I'm here to bring you the weekly economic review for the week ending February 19, 2021. So today is kind of an anniversary. We'll be digging into that in a few minutes with our chief economist, Clement Gignac. So good morning, Mr. Gignac.
Good morning.
All right, so I'll do as usual overview of the markets, some economic news, and then Mr. Gignac will be there to give us some insights on the markets. So let's start with this week's market actions. Interest rates are still climbing everywhere pretty strongly. So in the U.S., we're above 1.3% now, which was a bit of a threshold that investors were looking at. So that means that higher interest rates in the short term is a headwind for bond portfolios. So minus 1.5% for the long index, minus 0.7% for the universe index. Year to date, a very tough start, minus almost 7% for the long index and minus 3% for the universe one. Equities, after a few good weeks, we've had a bit of a pause, but as we are recording this, markets just opened and we are in the green. So we'll see if they stay in the green today. Let's see how strong they are. So maybe the picture will change, but as of the close on Thursday, it was negative for emerging Canada and the US, positive for Europe and Asia. Year to date, emerging markets are leading the way, followed by the Nasdaq, then Canada, then Europe, then the US, but positive returns everywhere on equities, negative return everywhere on fixed income. Price of oil up close to 25% already this year. We're above $60, so a strong momentum here for the price of oil. Canadian dollar following suit of 0.13% on the week. Euro a bit down, and the US dollar was relatively strong this week. So usually that means a headwind for gold. So minus 3% almost for gold on the week, about 6.5% year to date. So maybe a look at the COVID situation. So here I decided to bring the current hospitalizations in ICU, so intensive care units in Canada. So as you can see, the trend is going in the right direction. So it's going down. So that's very good news. It's not really because of vaccination. It's more about the restrictions that we put in place, because if you look on the right, cumulative vaccinations per 100 people. So in the UK, 20% of the population is vaccinated. In the States, it's 15%. And even this morning, we heard that probably the return to normal in the US, according to Mr. Fauci, will be by Christmas time. But it's very likely that they'll have enough vaccines to vaccinate everyone by Independence Day in early July. So the pace is very strong there. Of course, they produce the vaccines, so it's easier for them. In Canada, we don't produce any, so we're at the bottom of the distribution here, about 3.5% of the population vaccinated. Of course, last week we heard that 2 million doses should be coming in the next month. 2 million doses is 5% of the population, so probably we should see an acceleration all the way to 8-10% in the next month and a half, but it still remains to be seen. So early this year, expect Canada's economy to be facing some headwinds because of the low vaccination rate, and it was apparent in this morning's retail sales data. We had the data for December. It was a contraction in retail sales, and Canada StatCans, they have their forecast for January. They're expecting even lower than December figures. So the start to the year should be a bit hard. Recovery and economic recovery goes through consumption first. So if we have still restrictions because of low vaccination rate, we could have a hard time outperforming in early 2021. So expect the Canadian economy to have a tough start to the year and play catch up later this year. The U.S. economy is doing very well. More stimulus, of course. If you remember, during Christmas time, there was this 900 billion package that passed. Well, the checks were sent in January, and it showed in retail sales. If you see on the left, you see that the retail sales, it's still a V-shaped recovery. There was some weakness, but now they rebounded strongly. And on the right, you see that we hit the multi-year high in year-over-year growth. So lots of momentum in the short term for retail sales. And we know that there's more fiscal stimulus to come. So expect the U.S. consumer to be firing on all cylinders in the short term. This is service recession. It's not the manufacturing recession. So our industrial production in the U.S. is telling you that everything's going well there. On the right, you see that it's a big V-shaped recovery in this industrial production. We've seen other things like that also in Europe, in Japan, in China, so emerging countries. We are seeing a strong impulse in manufacturing, industrial production, and this is good support for global recovery in 2021. So it's a good sign that we see manufacturing being so strong. Finally, on the economy, Canada, home prices up near 10% year over year. That's led by a rush to the suburbs. On the left, you see the pace of growth of prices, the shaded region, the blue shaded region. So we're up at about close to 10%. The peak was in 2016 when we reached 14%. So maybe we'll go there because there's this rush to the suburbs, as I mentioned. People are leaving the downtown condos and going into single family homes in the suburbs, but also downtown. There are some houses downtown, and the prices of those are climbing very strongly, as we can see here. Toronto, Montreal, Vancouver, Victoria, strong growth there, and very low interest rates for a while. So there's no stopping this. And when you move from a condo and you go to a house, usually you have more space, so you need to buy more furniture. So that's also a trickle down effect for the economy. So a very good sign indeed coming from this. And also in the US, we see that the housing sector is a very strong tailwind for the economy. So good news there. So that wraps it up for the economic part. So now for financial markets, I'll leave the mic to you, Mr. Zniak.
Thank you. Very interesting, Sebastian. What a change compared to 6 months ago, or even last spring, a year ago, when you have this lockdown, the economy, and the sharp decline of the economy. And by the way, today, Sebastian, as we record, is February 19, and guess what? It's 1 year anniversary because a year ago was the ultimate peak of the stock market after the longest bull market ever seen and the longest business expansion ever seen. Suddenly, February 19 was the peak of the Wall Street a year ago and set the table for the fastest but as well the shortest bear market in history. I remind you that the market declined 34% on the S&P 500, as shown on the slide. It lasts 22 days, trading days. So that's the reason I mentioned that it was the shortest bear market in history. So, and suddenly, thanks to central banks, Federal Reserve bold move to be backstop on corporate bonds, and not to mention the G20 get together, who has put a lot of money, liquidity, fiscal and budget measure to set the table to avoid 30s style depression. So this is important. And guess what? Mid-August, we already recover all the losses and we have new time high. And now the market exceed 70%, the trough of late March. So this is one of the fastest recovery as well. So interesting. Next slide. We talk about this current environment. We have a risk sentiment very high. People, it's a risk on. Notice on the slide on the left side, this is a 20 years history. This is the percentage of it's a survey done by Bank of America. It's a percentage of people mentioning that they take more risk than normal. Okay, so this is a record level that we see so much people taking more risk than usual. We talk about institutional investors here, so it's interesting. This is maybe the risk, the fact that you have so few people talking about risk. It's probably a risk by itself. Next slide. As a result of that, not next slide, if you could be back. On the right side, I have to say, as a result of that, you have a huge inflow. Notice on the ETF last week being the largest inflow global equity ever seen. So very, very impressive. So the money is there. They have so much liquidity. Yes, next slide this time. We can talk about the first slide on the left side represent the ratio of a small cap compared to large cap. It's the yellow curve represent that. So you can notice the small cap has rebounded nicely. And the other slide, the blue one on the left side, is the ratio value compared to growth. So it's usually they get together, but this time people still go with growth stocks. rather than value stocks like the staples or the pharma and not the pharma necessarily, but the staples and the dividend stocks. So yes, the value stocks has not rebound yet, and usually they get together. It's interesting. On the right side, this is the Russell 2000. Notice now the index is 50% above its 200 days moving average. This is unprecedented. We have never seen that in the last 25 years, as illustrated on that chart. So it's 50% above. So it's probably normal at beginning you go so high, but at some point they have some people who take some profits, and not to mention that the 200 days moving average continue to go higher. So, but this is interesting to illustrate how fast is this market recovery in the small cap. Next slide. We talk about the asset, which asset classes benefit the most when we talk more about inflation. Before commenting on that, let's go with the first slide on the left side, is the break even on the bond market. So the bond market told us that inflation will start to accelerate. So now it's around 2.2%. This is the IRS reading in more than 6 years. So clearly, with the commodity prices very strong, this morning we have the copper above 4% for the first time in a while. So we have a situation like that. We have some cost pressure, transportation costs, many anecdotes in the transportation about container, and we have a bottleneck at some notice oil price as well was performed very well. So we talk more about an inflationary environment. So as a result, on the right side, we present the sensitivity of major asset classes to inflation. And notice, not a surprise, commodities, of course, is obvious winners. We have emerging currencies as well who benefit the most about that. Gold, and we have, but the asset class who suffer the most, it's of course U.S. Treasuries. So government bonds now these days in the repricing process. So for the time being, central banks are very active with their QE to control long rates, but it's not a yield curve control per se like after the Second War. It's more indirect through the quantitative easing. So maybe the Fed will have no other choice later on this spring if the long yield going up too much to readjust their QE to buy more the long bonds in order to control that. But for the time being, bond markets suffer of this booming economy that Sébastien you have just described before me. So a lot of things to watch next week, Sébastien. Back to you.
Yeah, sure. So thank you for this. We have more data coming next week. In Canada, we'll have the industrial product prices. So it's what kind of inflation is in the pipeline here. So an interesting leading indicator. In Europe, we'll have consumer confidence and also the inflation there. In the US, many things. Conference Board Consumer Confidence Index, always very telling of the mood of consumers, and of course the recovery will go through consumption first. So we need to have confident consumers, new home sales, durable goods, initial jobless claims, and finally one revision to GDP for Q4. So it should be a bit higher, but still around 4.2%. So that wraps it up for this week. Again, if you want to reach us, ia.ca/economy. If you haven't done so, you can subscribe to the newsletter. If you want a PDF copy of this presentation, just write at economics@ia.ca and we'll send it to you. So thank you, Mr. Gignac, for your insights.
Thank you. Have a nice weekend.
Thank you, you too, and to everyone out there. Enjoy the week, and we'll be back next Friday with a new edition of the Weekly Economic Review.